Hello everybody, this is Monica Main, and this is the second video of the Change Your Life segments. And in this video I'm going to talk about some nitty-gritty, very specific elements on how to financially change your life. I know that in a lot of self-help material there's a missing piece when it comes to changing your life, especially from the financial perspective. And part of that has a lot to do with the fact that if you don't have a very solid, specific step-by-step plan in which to change your life, from a financial or any perspective, then you're not actually going to go forth and do the things that you like to do with your life. And so this is one of the things I'm going to be presenting in this particular segment, is talking about exactly what you need to do to start the process of changing your life. So first of all, let's talk about the concept of success. Now, success has to be defined by you and not what society believes success should be. And so you first need to decide what is success and what does it mean to you, because success is not the same person to person. So you need to decide what that means to you. And it cannot be, success from a society standpoint. It has to be what success is in your heart. You cannot begin the process of being successful until obviously you figured out what success means. So to set out to be successful is sort of a fictitious type of goal. It's a phantom, just because of the fact that if you don't know specifically what success means to you, you can't go out and set out to do it. Once you define what your success is, then you can start building a doable action plan to attain it. Note that I said doable, and note that I said action plan. You do have to have an action plan, and it obviously does have to be very step-by-step and easy to do if you're going to set out and do it. Your defined success must be something that makes you happy, has to make you excited, enthusiastic, motivated, and enough to make you want to jump out of bed every morning. So you do have to figure that out, and that's not going to be the same for everybody. So you need to figure out what that means to you. I will tell you from experience, successful people are very consistent with driving toward their goal. Notice I said consistency. There's consistency in driving toward the goal. It's not just a matter of making a wish list for yourself and then doing nothing about it, or starting an action plan and not finishing it. They're very consistent with going toward the goal, even if it's little by little. You have to delete any bad, non-productive, and hindering habits from your life if you want to be successful. You have to add new, good habits that service your end goal or vision. And if you don't get the results that you want, you have to keep swinging the bat. Successful people just keep swinging and swinging and swinging until they get what they want, because the way math works and the way scientific, I guess you could say, strategies on getting what you want works, is that you have to put in a mathematical equation. The more times you swing the bat, the more you're going to be able to hit the ball, even if it takes a lot of swings to do it. If you only swing the bat once, the likelihood of you getting what you want is simply not going to be existent. So, a lot of successful people have failed a lot in the beginning, but they just keep standing up and swinging until they get what they want, and that's the key. You have to choose a specific path to get to where you want to be successfully. When my students fail, usually they do nothing. Unfortunately, they barrage themselves with way too many options, and then they end up, in what I call the information paralysis mode, where they have so much information that they end up doing nothing, or they don't know what to do. So you can't do that, otherwise you'll be in a tailspin. You have to work through your fears as quickly as possible. Fears will hold you back. This means failing as much as you can, as fast as you can, because the more failures you get through, obviously that means you'll get to your success much faster. Educate yourself as much as possible, and you have to use bona fide and legitimate information, but you can't overload yourself, or you can't poison your brain with any tainted or bad information. That's always the worst part about dealing with some of the students that come into, I guess you could say, my network, because they've already been tainted with a lot of bad information out there. And having no information and starting off is sometimes better than being poisoned with bad information. So you need to make sure you have the correct information when you get started. You have to create a bite-sized action plan with a lot of very small and very easily attainable tasks. The more tasks you have on your action plan, the better, because it means that if they're super easy to do, you'll get through it. And they have actually done a psychological study, and they have shown that people that have a things to do list that actually cross out items that they've done and they've completed. It actually increases some kind of positive, I guess you could say, brain chemistry element that actually makes them want to do more, and actually makes them happier knowing that they've crossed off a task that they've completed. And so the more tasks that you can create for yourself that are easy to attain, the more you're going to be able to motivate and promote your brain to continue to want to do more for your project. Understand that tweaking a plan is going to be required as you go. This means tweaking and changing. You might have set out to do a plan and you maybe changed your mind on certain products or things that you want to do out there or sell out there, and that's completely fine. And that's part of the normal process of being an entrepreneur and being successful. You have to get started. You have to actually go forth and do it. The hardest part sometimes is getting started. Nobody knows everything about a certain subject. One of the other problems I have with some of my students is that they want to learn everything there is to know about, say, for example, apartment building investing or commercial investing. And, you're not going to know everything. I didn't even know a fraction of what I know now when I first got started. And I learned a lot, obviously, by doing. So just get enough information to where you can be capable and be successful and be on a successful path, but don't try to figure out everything before you start. Otherwise, you'll never get started because there's no way you can you're never going to know everything until you start doing it. That's just reality. So it all starts with your financial freedom point, and we talked about that in the last video, and your life vision, which we've also talked about, but I'm just giving you a refresher here. And then after you do that, you start building a plan. And you get there to get there within the shortest amount of time. So you build a plan, and the plan has to be to get you from A to Z as quickly as possible. So my plan is what I call aggressive to passive income for financial freedom. We sort of went through this before. Aggressive income is my New Wealth Ninja strategies, which I'll talk a little bit more about as we go along. Home-based business opportunities that you can actually do that are legitimate and not, some envelope stuffing scheme or multi-level marketing scam. The legitimate home-based businesses and not some scammy pie-in-the-sky thing. Flipping real estate also falls under the aggressive income strategy because it's not a passive income strategy. Passive is when you hold on to the real estate. When you flip, it's actually considered aggressive. Then you have the passive income side, which is real estate. You buy and hold assets, which means that you buy it and hold it possibly forever. That's the ideal scenario. And preferably you're going to be sticking with smaller properties like single-family residences, quads, which are fourplexes, small apartment buildings that are between 5 and 24 units, and mobile home parks. So you probably remember this chart that we did. I did this in the last video. And so we'll fill in the blanks here. And we have on our aggressive side our home-based business opportunities, our distribution profit business, which is something I teach, aggressive income real estate, which is flipping, mostly single-family residences, although you can flip apartment buildings as well. And then on the passive side, you want your single-family residences, which you can only get if you pay 100% cash. You don't want a mortgage, which I'll explain later why. Multi-family, which is 2 to 4 units because they fall under the residential loan category. They're not commercial loans. Apartment buildings, which are 5+ units, which fall under the residential commercial and the commercial loan category. And mobile home parks. And if you remember the setup, this is sort of my example setup of if we are here now, March 2014, and our end date, I quit date would be December 31st, 2016. If we figured out our financial freedom point was $2,500 a week, and then obviously you multiply that by 4 to get $10,000 a month. And then if we have a financial freedom point of the last day of 2016, our halfway point would be around January 1st of 2015. And the halfway point is significant because that's about the point where you should have built up your aggressive income between March 2014, which would be now, and then ramp up your aggressive income side to the point where it's profitable by the halfway point. And then by the halfway point, you start dumping as much of your money from the aggressive side into the passive side. So that's how that works, and that's why you have your halfway point, because that gives you some sort of perimeter on when you should start dumping and funneling your money over. If you can funnel your money over before that halfway point, that's great. But usually you need time to build up your aggressive income side to make it profitable, and then by the time you're making it profitable, you should be funneling as much of that money by the halfway point into your passive income side. So that's sort of how the whole chart works. So remember the basic concept that we left you off on in the last video, where we are basically taking your aggressive income business and funneling it into your passive income investments. That's the ideal scenario. So how do you get there? Well, first of all, we have to be honest with what we have. We have to do a self-assessment, if you will. So, knowing that an aggressive home-based business is going to cost you anywhere from $100 to $1,000, sometimes a couple thousand, you have to understand, what do you have available to be able to work with, and do you have at least that? Working with aggressive income real estate, it's going to cost you anywhere from nothing to $5,000, sometimes up to $10,000, depending on if you have good credit or not. What does your personal credit look like? What is your mid FICO? When you pull your FICO, when you pull your credit report, I recommend you use Experian.com. Get the $40 package to pull what they call a tri-merge report, which is a trio of reports from TransUnion, Equifax, and Experian. So you get the credit reports from all three credit bureaus. In addition to that, you'll get the FICO scores from all three credit bureaus. What is the middle FICO score? The middle one of all three FICOs is that's your mid score, and your mid score, in order to have decent credit, needs to be 700 or more. So what does it look like? 680 is where you want to be bare minimum if you want to get decent mortgage rates on commercial real estate. But to get the type of credit that you're looking for, business credit, to build a business, you probably want to be 7 or 720 over, with no bankruptcies and foreclosures in the last 5 years. And if you don't have that, then you need to start working on your credit. So this is how you do a self-assessment, is if you're not here, then start adding that to the list. Work on personal credit, meaning repairing credit and rebuilding at the same time. And don't forget the rebuilding part, because that's the most important part. Most people, when they start off with fixing their credit, they just start fixing it and they don't start rebuilding it. You need to rebuild it too. So you need to get the proper educational materials to learn how to do that, if that's not where you're at. Then you have to build business credit. Obviously, you cannot build business credit unless your personal credit's good. Personal credit should be somewhere in the 7 to 720 mid-score range before you can start applying for business credit cards under your business. So once you get your personal credit squared away, start learning how to build your business credit and get the proper materials from an educational standpoint to learn how to do that. Do you have any friends, family, associates, coworkers willing to invest in your plan, invest in real estate? You'd be surprised at how many people want to invest in real estate, especially now since the economy is starting to ramp up in full force. It doesn't take a lot of convincing for people to understand that real estate is a very solid investment opportunity, and especially when you start showing them cash flows on apartment buildings and so forth, it gets people very excited. You have no idea how many people are willing to ditch out their 401ks and put the money into something that's a little more stable, like real estate. So you're never going to know unless you ask, and you need to start figuring out if you have anybody in your pod of people, if you will, to be able to do this, help you with the plan. Like I said, selling the idea of investing in real estate is very easy in this day and age. Most people want to be included on the aggressive side or the flipping side, not the passive side. So you would have to be a good salesman to convince somebody to get involved in an apartment building deal, which would be a buy and hold deal rather than just flipping. But if you can make money flipping and you have somebody that's willing to front the cash for you to do that, then absolutely. Again, not a hard sell in this day and age to get people involved in real estate. You'd be surprised. So if you don't have personal credit, good personal credit, you're going to have to start fixing and rebuilding at the same time, but you can do this while you're starting your business. Of course, like I mentioned, you have to not forget about rebuilding while you're fixing. You have to fix and rebuild at the same time. And again, you want to get the appropriate educational materials to be able to do this. We do offer that through my website, monicamain.com. If you don't know how to do it, there's a lot of books on the subject, but you need to educate yourself with the proper materials to be able to do this. And then you need to be very consistent with the process, because fixing your credit requires consistency. You want a mid score that's over 700 to start getting business credit. And once you get over that 700, then you can start building your business credit for business credit cards and what they call blocks, which stands for business lines of credit. So you can't do that until you start getting your mid FICO over 700. And then you need to, at the same time as starting the process of fixing your personal credit, if it's in disarray, you need to now choose an aggressive business. If you want to invest in a passive income real estate, something like that, you're going to need some cash, obviously, to do this, and you're going to be able to do it through aggressive businesses, where you're going to be able to raise the money to be able to invest into passive income enterprises. Now, I will tell you that you can raise the money through private investors and so forth. And if that's the case, if you want to skip the whole aggressive business thing and get involved in real estate, buy and hold investments in passive income real estate, you can actually do that. But you're going to have to learn how to raise capital through private investors, and you can get the educational courses and materials for that. I offer that also as well. In addition to that, there's a lot of books on the subject of raising capital and raising funds for real estate. So you do need to have the educational background to be able to do this first before you go into that. So you can actually skip the aggressive business side altogether and just get involved in passive income, but you do need to raise the capital if you don't have the money down, because usually most of your residential commercial real estate deals are going to require 20% down to get an 80% LTV mortgage. So you're going to need 20% down, and if you don't have it, then you're going to have to find an investment group that can invest in the property with you. And there are ways to do that. But assuming you don't want to do that, or assuming that you want to make your own money, or maybe you want an aggressive business in addition to raising capital through investors, the aggressive business maybe can replace your current income because you hate your job or your business now. So you choose your aggressive business at this stage of the game. This is when you start the process of choosing what you want to do. You need to choose an aggressive income strategy that interests you the most. You don't want to be overwhelmed with excessive amounts of information. You certainly don't want to have the option of having 10 different aggressive income businesses to choose from or to be starting the process of doing. Otherwise, you're going to end up doing nothing. That's one of the problems, again, I have with my students, is that they'll pick 2 or 3 different things to start doing, and then they end up doing nothing because they're just completely overwhelmed. So you have several businesses to choose from. This would fall under the aggressive business category. You can do offline and online marketing strategies. This is my new internet business strategy. You can do eBay or Amazon by selling products through either or both. I have students that, I have a couple students that are making between $60,000 and $80,000 by doing this a month. You can do Kindle, Amazon Kindle download ebooks. I have a couple students who are making $20,000 plus a month doing that. You can do a distribution profit business. I have some students that are making anywhere from $30,000 to $60,000 a month doing that. And you could do aggressive real estate flipping. You can even flip apartment buildings by taking a rehab property, getting what we call wet funds. Basically, you get money from a company that will fund the entire project for you. And then you have to rehab it and flip it within 60 to 90 days, depending on what the arrangement is. So it's called deferred wet funds to be able to do that. So you can do that as well. I typically don't recommend that a lot of my students participate in rehab projects unless they have experience, because rehab is tough if you don't know what you're doing. So just keep that in mind. But you need to pick something out of the aggressive side. And again, get the educational materials. I offer educational materials on all of these items, or you can find books and stuff on these topics. But these are your best bets for legitimate aggressive businesses that cost next to nothing to do. You have to choose. I don't choose for you. You have no idea how many people actually want me to choose for them. I don't know what you have an affinity for. I don't know what you have an interest for, and I cannot select for you. I could select for myself, but I cannot select for you. So you have to choose your own stuff. So please don't ask me to choose for you. And then after you choose your aggressive side, and I recommend you choose one thing to do for your aggressive side, you then choose your passive side. And you choose your passive side even long before you're going to be doing the passive income side. You don't want to choose after you have a boatload of money to invest in. You want to choose before you have the money, so you know what to do with it on a dime the second you get the money, what to shovel and stuff your money into. You don't want to be dilly-dallying around and figuring it out later. You want to figure all this stuff out up front, even though you might not be investing in passive income real estate or investments for a while. So one of your options is to buy single-family residences, but you have to do this with 100% cash. You don't want to have a mortgage on a single-family residence. This is where a lot of people got in trouble, especially smaller investors, is when they had a bunch of mortgages on a bunch of single-family homes. The first thing that happens is during a recession, a lot of people lose their jobs and their tenants are not paying on the rent. And then when the tenants aren't paying on the rent, that means you, the owner of the property, have to now kick in some money to pay the mortgage, or you lose the house. And you probably won't be able to do that with 20 or 30 houses if you lose a good portion of your tenants or they're not paying rent. So this is a high risk situation for real estate. So do not buy a single family residence unless you're able to pay with 100% cash. But this is definitely doable. Like in certain areas of the country, you have single family homes that are between $15,000 and $50,000. And if you're making, from an aggressive income real estate or aggressive income business, if you're making anywhere from $20,000 to $50,000 a month, you could easily buy a house a month or a house every other month with 100% cash in certain areas of the country. So the rule is when you buy single family residences as buy and hold investments, meaning you're buying them and holding them essentially, hopefully forever, you want to buy with 100% cash if you're buying single family homes. That's the rule. You can buy multifamily residential, which are 2 to 4 units. These would be duplexes, triplexes, and quads. The reason they're considered residential is because if you get a mortgage on these properties, according to the bank, these are considered residential loans and they're not commercial loans. But of course, with these particular properties, you're going to have to put between 20 and 25% down to be able to qualify for these residential loans, and you're also going to need good credit, which is why we start off with the credit assessment, which is the first step to all of this. And then there's small apartment buildings, which are between 5 and 24 units. These fall under the commercial loan category. And you're going to need 20% down in most areas of the country to be able to make these deals work. You're also going to need good credit. Goes back to the credit again. Here's some other investment vehicles that you need to do in addition to all the other stuff above, or one or more of the things above. And this is stuff that you do later on after you start getting some of your properties, is you might want to consider something called a fixed annuity, which is almost like a mutual fund, except that it never goes down. You never lose any money in it. It only goes up or it stays the same. So that's one of the reasons I like fixed annuities over mutual funds or stocks or bonds or commodities, is that if you put $100,000 down into it, you never lose money in it. It only goes up according to what the stock market does. And if the stock market goes down, it just stays the same. So that's one of the no risk, I guess you could say, or low risk financial instruments you could use. There's a SEP IRA, which is for small business owners, which you're going to have a business when you start your aggressive income side. You're going to get an S corporation when you start that. And again, that's all part of the additional learning and educational materials that you get when you start your aggressive income business, is that you're going to understand that you're going to need an S corporation in your home state to start off. So now that you have a business or an S corporation, you can now get a SEP IRA or an IRA, which you can get as an additional means of parking money. You can have a Roth IRA, which only gives you limited amounts of money to put in every year. But again, it's an additional retirement instrument. And then universal life insurance, which is an investment that you basically make every month. And it pays out after, I guess you could say, certain time frames in your life. It'll pay out certain amounts of money. So it's a good retirement fund. In addition to that, it gives your family life insurance if you pass away. So those are all additional instruments from the investment side that you should consider after you start getting your passive income property. Okay, so how to retire in 36 months. Here's how it works. When you reach your financial freedom point with your aggressive income, I don't recommend that you terminate your current means of income from your current job or business until you're able to funnel your aggressive income funds into your passive income real estate. And then when your passive income real estate or investments start kicking out the amount of money that meets your financial freedom point, then you can retire. That's how it works. Believe it or not, it only takes a few properties to get to your passive income financial freedom point. A lot of my students think that they're going to need 10, 15, 20 properties. But believe it or not, you only need a handful of real estate to be able to make this work. So you can actually get the real estate within a short period of time. Now, if you remember my chart that I had before where I talked about the midpoint being January 1st of 2015, if I were to actually go by that chart and I were to start shoveling the money into my passive income real estate from that point forward that I made from my aggressive income, I would easily be able to retire by the end of December 31st, 2016, based on that chart. And so that's how it works, is that you start funneling all of the money into those passive income real estate transactions. And I will tell you that since you only need like between 5 and maybe 7 properties to be able to make it work, depending on what your financial freedom point is and depending on how much each building or property is going to make for you, you can easily get those 5 to 7 properties within anywhere from 9 to 12 months. So that's why this is a very doable plan to do as long as you follow suit with exactly what's required. You're not going to be entirely free when you just build your aggressive income business, especially since many aggressive income businesses, especially with the internet and so forth, a lot of the marketing strategies change every 6 months or a year. And so you might have something that you have that's a hot business, and maybe it just completely and totally dries up within 6 months or a year after that, because of so many different changes. And ask anybody who has done Google AdWords advertising, they'll tell you that they had multi-million-dollar businesses that virtually dried up in a year due to the fact that Google changed all their algorithms in their AdWords. And so if you have an aggressive income business, don't let that be your end all be all and then you quit your job and everything's great. You need to make sure that your financial freedom point is met by your passive income side, meaning all the aggressive income that you funneled into your passive income real estate, that's actually kicking out the money that you need. And then at that point, you can consider yourself financially free, if that makes any sense. So why do I recommend smaller multifamily apartment buildings? Well, I will tell you from experience, the larger the apartment building or the larger the property, the higher your expense ratio goes. So for example, you're going to have gross rental receipts that you receive every month from your tenants, and the more units you have and the larger your property, the more percentage, the higher percentage of your gross receipts will have to go back out to expenses for the property. It seems like it would be the opposite, but it's not. When you have a lot of small multifamily properties, meaning that you have apartment buildings that are 24 units or less, your expense ratio is going to be smaller. It's only going to be 40%. So if you're making $100,000 a year on a property, only $40,000 of it will be going out in your expense ratio on a smaller property. However, if you're making $100,000 on a large property, you're going to be looking at about $65,000 of that going out. So it's a larger percentage on larger properties going out in expenses. So it's better to have a whole bunch more of your smaller properties than to have just a few larger properties. And so a lot of my students don't understand that. They want their first deal to be a 100 unit plus apartment building. And not only is it much harder to qualify for from a bank's perspective, just because they're going to want you to have a management resume and a portfolio of other properties as an investor. They're going to be looking at that. So it's harder to close on that for somebody who's a newbie investor. But in addition to that, a lot of these people don't consider the fact that these properties are much more expensive to run and operate because they are larger. There's more landscaping that needs to be done. There's more common area maintenance, common area electricity. And so they don't realize that functioning a larger property is much more expensive. And so what I tell my students is get as many tiny, rinky-dinky small properties as you can get because you're going to be, bottom line, have more cash flow in your pocket. I've always been partial to multifamily and apartment building investing. Pretty much is from the moment I discovered this from a I guess you could say an associate of mine, I've been pretty much all gung-ho about apartment building investing because they're much more profitable. And whenever you go through a recession or a depression, which we always go through because we have cycles in our economy, these are the ones that withstand the recession depression modes. Commercial property like office buildings and stuff like that, they really don't do well in the recession. And you're always going to have a recession, so why not line yourself up and be prepared and get properties that can withstand that. You can also consider what I call commercial, which are your office buildings, industrial warehouse. But you have to be specialized in that. You have to really like it. You have to really be good at it. And you have to basically be tunnel vision and focused on that. And if you're not willing to do all that and live, breathe, and eat industrial warehouse space or office building space, then I don't recommend that you do it. Mobile home parks are also very profitable, but again, it's its own animal, if you will, and has different requirements, and it's a little bit different than apartment building investing. It could be a lot more profitable than apartment building investing, but again, it has to be something you have to get really good at and have tunnel vision on and it has to be your forte and the thing that you mainly invest in. It's not something that you could diversify into. Commercial is very risky. It's not recommended for a newbie investor. And MHPs, mobile home parks, like I said, it's a different animal. You could start off with mobile home parks, but like I said, you need to be very focused in on these. You can't just diversify and add this into your portfolio of apartment buildings because these are very different creatures. They're different types of properties. They have to be handled a lot differently. So, your basic premise looks like this, your overall big picture. You find your financial freedom point by adding up all your current expenses to sustain your current household or lifestyle. You get your aggressive income going, and then you purchase a handful of properties, hopefully smaller apartment buildings and such, like I discussed. You can then increase your monthly dollar amount or your financial freedom point to something larger. You might even go double if you want. And then you would increase it by getting more properties. You then purchase more properties to meet that passive income goal. And then at that point in time, then you can invest in additional cash flow types of passive income, like what I was talking about before, with the fixed annuities, with the SEP IRAs, with other types of investment vehicles. You could then, at this point in time, where the pig is, at that point in time, that's when you start investing in those types of instruments. Some other important things for you to know. The longer you stay in the aggressive income game means that you could take 100% of the cash flow. You could basically take all the cash flow you get from your properties and use that money to pay the principal of your property mortgages. And so the longer you keep generating aggressive income, that means that you don't have to start sucking off of the passive income that your properties provide. Instead, you could take that money and shove it right back into the property and pay the principal down. So if you do this, you should be able to pay off your mortgages on all your properties within 5 to 7 years, and then doubling the cash flow on some of your properties in some cases. In 15 to 18 years, rents will usually double in most areas of the country, and then that even creates a larger cash flow for you. So just know that this is sort of a built-in retirement fund for you. And if you can tell me any other retirement fund that will increase this fast outside of multifamily and apartment building real estate, let me know. There isn't any that I've ever found that do this type of financial strategy for you. So you map out your entire plan. Even before starting your aggressive income business, you should choose your passive income strategy. It basically goes in two parts. You first have to choose the asset class you want to specialize in. For example, it can be mobile home parks, although I recommend that you go with your smaller apartment buildings. I prefer that you choose that. And then you need to choose a location where you're going to invest. Obviously, it's always good to start off in your own backyard or within like a 100-mile radius of your house. Of course, this isn't always possible. I live in Southern California, and investing in real estate in Southern California has always been extremely difficult to do because you just don't get the same value, the cash flow value. So I've always invested on the East Coast and the Midwest and certain areas of the country that actually give me a bigger bang for my buck, if you will. So if that's the case, where you live in an area where you can't really find any cash flowing properties, you can build an empire, but it has to be in a single locale, not spread all over the place. You don't want to have property in Houston, property in St. Louis, property in Cincinnati, property in Atlanta. You want to be able to pick a singular locale that can give you the best possible financial potential. And you want to have your entire empire in that one singular location. Even if it is 3,000 miles away, so what? As long as it's one area, you can create a management plan to be able to adequately service those properties without too much of a headache, okay? No more of a headache than you'd have anywhere else, even if it was in your own backyard. So you can pick a singular locale, but the key is obviously it has to be a singular locale and not multiple locales. You have to make all of these choices even before you begin to make any money with aggressive income. You want to be able to know exactly where you're going to be going with your money and what you're going to be doing with it before you even start with aggressive income. So you'll know right away what to do. So once you map out your plan, then you need to make your assessments. What type of education are you going to need to be able to pull this off? Does your personal credit look like crap? Because if it does, you're going to need to learn credit repair and rebuilding. If you want to raise capital through investors, maybe you want to skip the whole aggressive income strategy. And if that's the case, you need to really learn how to raise capital through private investing. They're going to be allowing for private individuals to do crowdfunding for real estate later this year. And so look out for that. So you need to learn how to do all this, and you need the proper education materials that'll teach you how to do that if that's the route you want to take. If you want an aggressive income business, choose one. Remember, we're not choosing a ton of them. We're only choosing one option. And remember, later, if that option doesn't work out, you can always switch. But I recommend you start off with one aggressive income strategy business. Pick one, learn the educational materials you need to get that started and get that underway. And then you need to choose your passive income strategy. And then you need to find the educational materials for that. So that's what you need to know. In order to be able to pull off this plan, you have to have the education to be able to make this work. So you need to gain the knowledge, the appropriate knowledge in each department. See above for the departments that have sort of laid out for you. Don't overdose on education, because this will send you into a tailspin. You'll go into information paralysis and you'll end up doing nothing. So choose one thing from each department and stick to it. So you have your credit repair. If you need that, if you have good credit, good for you. And if you do have good credit, start with business credit building then. If you don't have good credit, start with personal credit building and repair. And once you sort all that out, then you can start with the business credit, because you do need to build business credit. Decide if you want to do aggressive business or if you just want to raise capital through people to get right into the passive income, right into the apartment building investing. If you decide you would like to have an aggressive strategy business, maybe in addition to raising capital because you want to have a business to be able to quit your job, then choose one aggressive income strategy and then choose one passive income strategy, including one singular area in the country to invest. Move forward through your fears. Fear really puts a damper on your dreams. It really does. And you have to ask yourself, whenever a fear comes up, what's the worst that can happen? Are you afraid to talk to a real estate agent on the phone? Well, what are they going to do? Reach through the phone and strangle you to death? Are they going to yell at you or call you stupid? What is the worst that can happen? Because you'll notice you'll get right over your fears very, very quickly if you start playing it out in your head. Well, what can possibly happen? Well, nothing. Well, then what am I afraid of? And you have to start asking yourself those types of questions. You want to be able to develop skills that you have to practice every day. If you do an aggressive income business, some of them require learning how to build a website. Very easy to do, especially with WordPress and GoDaddy website. It's not called Website Tonight anymore. It's called Web Builder or whatever it's called. Very easy to do, but you're going to have to learn some skills. It's going to take some time. Push through those fears and learn those things. What are you going to need to learn and be willing to learn it? Maybe you're going to have to develop a skill talking to real estate agents and brokers and sellers on the phone without freaking out or panicking or being afraid. There's a lot of things that you're going to have to be able to develop skills for. Maybe doing presentations for investors, maybe putting together business plans for investors. You're going to have to learn some skills. And the only way you're going to be able to learn them is by practicing every day and actually doing it consistently. So this is the part where I tell you to start getting your plan together. Start looking at your end vision. Start considering all the things that you have to do to get the life that you want, and start putting together a very doable action plan that you can do in bite-sized pieces, and choosing all those categories you need to work out stuff through. And if you need some educational courses and materials to look at, you can always go to my website here, monicamain.com. Otherwise, there's a lot of books on different topics and subjects, especially when it comes to repairing personal credit and rebuilding personal credit. There's a lot of different things out there that you can do. Just make sure that it's the right information. It's not bad information, because bad information in many cases is much worse than having no information. It poisons the mind and puts you in the wrong direction. So you don't want that to happen. So, like I said, I'm not the end-all be-all to all the educational things that I pointed out. I do have a lot of things that you can use and tools that you can use, but if you don't want to use my tools, that's fine. There's a lot of books and courses and education out there, but you do need the education to be able to, move forward and move through the action plans that you're going to be developing for yourself. This is Monica Main signing off. I'll see you at the top.